Good evening, ladies and gentlemen. On behalf of Axis Bank, I welcome you all to the sixth edition of our Treasury Market Talk series to discuss Once in 100 Years Budget. Participation in the webinar is by invitation only. Axis Bank reserves the right to block access to any person to whom an invitation is not sent. Unauthorized dissemination of the contents of this webinar is strictly prohibited, and prior explicit permission and written approval of Axis Bank is imperative. As a reminder, all participant viewing panels will be in the view-only mode. Participants who wish to ask questions may post them on the question box on your screens. Please note that this conference is being recorded and may involve the presence of the press or media. Before we begin, let me take a moment to introduce our panelists. Our guest speaker for today is Dr. Arvind Subramaniam, former Chief Economic Advisor to the Government of India. Joining him on the panel to share in-house views will be Mr. Rajiv Anand, Executive Director and Head of Wholesale Banking, Axis Bank. Moderating this eminent panel is Mr. Saugata Bhattacharya, Chief Economist, Axis Bank. On behalf of Axis Bank, I once again welcome all the participants to this edition of Treasury Market Talks Once in 100-Year Budget. I now hand the conference over to Mr. Saugata Bhattacharya, who will be steering today's discussion. Thank you, and over to you, Saugata.
Hi, many thanks, Ajit. It's a real privilege and honor to welcome Dr. Arvind Subramaniam to this sixth edition of Axis Bank's Treasury Market Talks, the backdrop to the 1 in 100 years budget. Rajiv, thank you so much as well for joining in. Rajiv has been a steadfast supporter of this series. So we'll go through the discussion for about 45-50 minutes, and then we'll open up the platform for Q&A for another 15, 20, 25 minutes, depending on the time. So let me begin. Let me begin with the growth environment and economic activity. So economic activity certainly seems to have recovered much stronger than we had expected. The economic survey that's been released today forecasts 11% real growth in FY22, a 15.4% nominal growth, noting that the potential is for a very strong upside, given the factors that are driving the economic recovery and the drivers going into next year. So Rajiv, let me begin with you. That based on we all know the external indicators. So based on your conversation with clients, in addition to these external indicators, how much do you think that can this recovery be sustained over the next few months?
Thank you, Saugata. At the outset, let me add my welcome to Dr. Subramaniam. Thank you for doing this for us, and it's an absolute honor to share a panel with you, sir. So, to the question that you asked, I mean, whichever way you looked at it, I mean, whether it is anecdotally, as I talk to clients, and we've talked to clients starting from April to, literally yesterday, you could clearly see the shift in sentiment. I mean, in April, May, June, most companies did not know what exactly hit them. By the time they came to July, August, people were talking about the fact that capacity utilizations were back up to about 50% or so. We are now coming to a situation where so many companies are either talking about the fact that raw material prices have gone up and therefore they need to up the prices for their end product, or they're talking about shortages. So I think the shift in terms of sentiment that we are seeing from our customers has been, sort of in that sense, quite phenomenal. If I break this up into agricultural and agriculture-oriented, rural-oriented businesses are doing very well. Manufacturing is doing very well, but clearly what is the weak spot is services. If you talk to restaurants or cinema companies, etc., we continue to struggle. Like you rightly said, if you look at high frequency indicators from today, they're all the recovery is much faster than we had anticipated. So whether you see freight indicators, GST revenues, e-way bills, electricity demand, all of them are sort of much better than anticipated. If you look at things like order books of ball bearing companies, a great indicator in terms of what is happening to manufacturing, we are actually seeing shortages. So I think net what we are clearly seeing is is that the formal sector is doing much better. I think what has amazed me is the resilience and adaptability of corporate India during this period. Remember that there was no playbook that we had to be able to deal with the pandemic, and certainly didn't have a playbook to figure out how to deal with a complete lockdown and a 1 month full of zero revenues. I mean, I think I'm sure you saw that Maruti had actually announced that they sold not a single car in April. To come from that environment to where we are today, I think is the classic V-shaped recovery, isn't it? But I think, but just a note of caution here. And if I, if you go back to what happened post demonetization, I think the formal sector of the industry was able to grapple with the issues much better. But it was really after about 18 to 24 months where we began to see, as data got collected from the informal sector, how much of a damage there has been in the informal sector. And I think we will have to wait and watch as we get into 2023 on how much of income destruction and therefore demand destruction has happened in the informal sector and how much of an impact it has as we go forward. But I think in the formal sector, as we stand today, look at the Q3 numbers, very strong.
Thank you. No, it's a great point, a very valid point. That with the discrepancy between and you're absolutely right. The actual the GDP numbers probably reflect much more the formal sector, and as the revisions will happen, that will begin to reflect more on begin to capture the informal and the smaller segments of the business and economy. But I mean, the one key consequence of exactly what you mentioned in terms of the formal sector doing better, being more resilient, being more agile. And Dr. Subramaniam, now this is a question for you. I think this has been a topic of discussion, extensive discussion across the world. I mean, it's not just India. So is this apparent disconnect between the real economy and equity markets? So what do you think are the drivers? How long do you think can this divergence sustain? So over the medium term, and as a follow-up on this, so that's one part of the question. And then over the medium term, because that will also have an impact on equity markets' view on the markets. So how much will the scarring that Rajiv referred to in the informal sector and across other segments, how much of the scarring and the accelerated changes that we are beginning to see now, can that change and impact India's potential growth? So two parts of the question. So the immediate disconnect and then the impact on potential growth as a long-term driver of equity markets.
Yeah. Of course, first of all, thanks to Axis Bank, Shagota, Rajiv, for having me. It's a great pleasure to be on this panel. So let me begin with the disconnect question. As you said, quite rightly said, this is a global phenomenon. India, the United States are certainly seeing this in very acute measure. And we know, I think we understand some of this. We don't understand all of this, I think, as yet. I think the part we do understand is that one, global liquidity conditions are not just going to be easy today, but are going to be easy kind of going forward. So if you look at the decline in US G-Secs and split it up between how much of it is a term premium effect and how much of it is expectation about future short-term interest rates, and the latter accounts for much of the decline in the G-Sec. So basically, the market expectation is that Fed, all central banks are going to keep things very easy going forward. And of course, that in turn, markets have confidence there because it reflects a broader consensus that, this time around, we have to be supportive because it's been such a devastating impact. So I think that the easing is one factor, and that applies to India, of course. India has also had India is affected both by easing of global liquidity as well as what the RBI has done, so that weighs in as well. The second part, I think we understand, it kind of reflects a little bit what Rajiv said, but more globally, is that we have to keep in mind that this equity kind of surge, perhaps a bubble, reflects exactly the fact that some sectors have done better than others. So tech sectors, manufacturing sectors have done commodities have done relatively better. Services, even within that index, have done relatively less well, and kind of reflecting exactly the disjunction that Rajiv said. But I think the part that we don't understand is still whether all this run up in equity prices is warranted by fundamentals or not. And I think that's going to be a question that dogs us, over the next few months. And let's be honest, the consensus view now is that there is a bit of a kind of, overvaluation, because, PE ratios are just off the charts. And, we know from the work of Robert Shiller that when price equity ratios get completely out of line, it's a sign that markets are going to start declining going forward. So I think that's why we should all be a little bit, Rajiv's note of caution at the end, I think is very, very important, which leads me to your second question, and we're kind of building on this. See, there's no question that next year the economy is already beginning, is going to do well, and I think that point is well taken. Whether it's going to be 11% growth or 7 or 6 or 8, it's some a good healthy number. We don't know how much exactly it's going to be, but the scarring is in two important respects, I think, and we can talk about the others. One is, we know that the employment situation has been pretty badly affected. The limited data that we have comes from the CMIE, and roughly mota, we think that about 15 to 17 million fewer people are employed, at end of 2020 compared to before the pandemic. And that's going to weigh in on demand, consumption, and all the things that we care about. Also, let's not forget that labor market in India, that damage, also has a spatial component. We realized how integrated Indian labor markets were, how reliant we were on, migration and migrant labor. So not only is there a scarring, but, we need to get labor mobility back to the old levels in order to, undo some of the scarring that's happened in that. The second big scarring, of course, is, we'll come to that later, is what's happened to the financial system. I was very, very impressed by the candid assessment of the Reserve Bank of India in their stability report, when they said, in the baseline scenario, NPAs are going to go up from 7.5%, to 13.5%, 14%. I think the note of caution I will just inject here is that, yes, we are going to, rebound this year, right? But it's on the back of the worst ever decline, since 46, or, whatever, it's 8%, 10% decline. That means about 10% of activity has been, destroyed. And therefore, going forward, that will certainly get reflected in the financial system. And therefore, our ability to recover beyond this year, or maybe in the second half of this year, will very much depend upon the permanent scarring being addressed in some meaningful way or not. One last point before I leave it to the others, is that on the upside, it's not just global liquidity that's going to do well. We've just, trade is going to pick up again. The IMF forecast for global trade is for a, big recovery in global trade. And of course, because manufacturing is doing well, I think trade is going to be impacted well, because global trade is, about 2/3 manufacturing, 1/3 services. I actually think that manufacturing will do well, But global services trade, I think, will also do well, precisely for the reason that, services domestically may do less well. Activities that can come, especially for India, the fact that you can't have physical contact in the United States, it may be easier to do this online, and therefore I think there is a little bit of an upside there for Indian exports of services as well. So let me stop there.
Would you like to add anything on this topic of India's from a credit standpoint? I completely agree. So there's just one thing in India that I think might actually happen. Next year, there might be a recycling from the manufacturing-led recovery that we have seen thus far, and probably likely to continue till the vaccines and confidence are established. Is that there might be a recycling of demand back into the contact services segments, travel, hospitality, etc. How that plays out with how much of manufacturing demand gets replaced, etc., would still need to be seen. But services-led delivery growth recovery in India might actually begin to pick up from the middle or quarter 2, quarter 3 of the next year. So that's something that needs to be watched. What kind of behavioral changes?
Shobhita, if I may just say one thing, sorry to interrupt, is that, look, I think when we think about the forthcoming year, I think one of the reasons we are optimistic about India is because we've got the pandemic a little bit more under control than the rest of the world. I think is clear. Numbers have been declining steadily for almost 2 months now in India.
Absolutely.
Whereas in the West, it's been very erratic. There have been second, third, maybe fourth waves and so on. But I think the whole pandemic situation if there's uncertainty in the economy, there's kind of even more uncertainty on the pandemic. I'm not an expert. I think that there is a little bit of caution that one should have. Everything that we say can reverse very quickly if something happens on the pandemic. And that's why I think we should think now a lot in terms of, the kind of, we always, financial markets always think in terms of rewards and risks, but now there's not just more risk, there's kind of things that we don't fully understand, what we call not just uncertainty, but nighty and risk. And that's, I think, going to be, what Mervyn King has called, radical uncertainty. I think that we're going to have to cope with. So in a sense, the psychology of understanding and investing has to reflect, something genuinely different that's going on going forward.
I think great point. I think that's a great point. I mean, the uncertainty itself, the nature of the uncertainty is likely to keep shifting. I mean, in the immediate next few months, driven by the course of the pandemic, then thereafter all the behavioral technology, other changes that are coming into play. So that's a great point. So, but again, I think that brings us to the second set of issues in terms of managing this uncertainty, the recovery, the underlying support to the lower income segments, the most affected segments, vulnerable segments, etc. So obviously, as everybody knows, the finance minister has announced that this budget will be like never seen before. So of course, in one sense, that's true. That being in a budget formation in a pandemic situation, a lot of it having been virtual in its construction. It would be that itself is, but that's almost tautological in a sense. So, Dr. Subramaniam, then, so what's your call if you were to design such a never seen before budget? What would be the contours? Please help us in understanding, leading us through the processes through which the budget is made, and then the actual contents of the budget. Managing the trade-offs between how much fiscal space with the budget have, the government have, what are the other off-budget exercises that might be incentivized in the budget, what kind of nudge behavior might be likely to see in the budget, what would be the balance between spending, the need for spending, to make up for some of the economic losses, and fiscal prudence, which the government has, seems to be a basic DNA of this government. So how would you manage the contour of such a budget?
budget making time in government is always a very exciting time, because it's really a time when you see all of government kind of working together. You have a series of meetings within the Ministry of Finance. The expenditure departments come and tell you what they need to spend for the next year, and then so there are discussions at the level of the Finance Ministry, but then very intensive discussions between the Finance Ministry and the Prime Minister's office. And of course, under this government, as you know, the Prime Minister's office is really a key locus of decision making, and so that interaction between the Ministry of Finance and the Prime Minister's office is really very, very critical, and it's very intense. A lot of going back and forth. Even until the last minute, the budget speech is kind of tinkered by all the big powers that be. So it's a very kind of interesting process. I think this year's budget, when we think about the budget, I think we should think about, one is it's all the numbers we're going to talk about, expenditure, taxes, etc., etc. But also this budget is important because what is the bigger reset in economic policy that's going to happen, which is, the announcements will be made in the budget, but of course, implementation, rejigging, recalibration will happen over the course of the entire year. So that's why this budget is important, not just because, what's going to happen on budget day, but what's going to happen in terms of, policy over the course of the year. So let's just first take the kind of numbers and priorities for this budget. See, in some ways, this budget actually is going to be relatively easy, and I say this carefully, because with growth bouncing back and nominal GDP growth, whatever, predicted to be very high, there's going to be a huge bounce back in kind of revenues as well. So this is actually ironically going to be a situation where revenues are going to be doing of course, the joker in the pack here, of course, is oil prices. That if oil prices start going up, excise taxes will probably have to be brought down, and therefore revenues might suffer a bit. But with that aside, this is going to be I think the expectation is that if nominal GDP growth goes up by, for whatever, 10, 12, 13, 14, 15%, revenues will grow up by even more. So this is actually going to be a budget where, the revenues are going to come in. And so it's going to make actually the expenditure prioritization possibly a little less challenging than in some years where the economy has been much weaker. So I think in that sense, this could be, in that sense, an easier budget. I think in terms of priorities, first and foremost, and the IMF also said this, and something that I said to Prannoy Roy the other day, is that, first and foremost, we cannot forget that people are still hurting from the pandemic. 15 million people still unemployed, wages have come down. So the social safety net that was put in place for the pandemic, Manrega, PDS, cash transfers, those will still have to be in place for some considerable time. So that's the starting point for the budget. We can talk about the future, but in the present, people are still hurting. So I think the social safety net is going to be, maintaining that will be, I think, very important. I think prioritizing, I think definitely infrastructure and health spending, are going to be two other big priorities. Health, because, I think the pandemic still, vaccination rollouts, beefing up delivery systems, I think that's going to be there. And of course, more broadly, we have to get investment back going. As we know, in the last 5 years, investment has been very weak. I think, and we'll talk about that in the context of the twin balance sheet challenge. I think that, and of course, I think politically, my sense, I may be completely wrong, that one response to maybe the ongoing agricultural crisis will be to actually, spend more on agriculture and kind of, in order to kind of douse or at least, if I were, I think any political strategy will want to kind of get that under control, and maybe therefore agriculture. So I think these will be the high priorities. Now, in terms of the overall this year, because revenues are going to be relatively okay, I think most of the expenditure increases can be financed. So the big question to me will be, and yesterday I had this big discussion with Olivier Blanchard on what should developing countries be thinking about medium term. I hope that the budget will signal credible medium term fiscal consolidation. I think this year, we know that debt has gone up to about 90% of GDP, 85 to 90% of GDP from about 70 to 75% last year. So, whatever people may say, oh yes, there's a lot of fiscal space. When people look at numbers, markets look at numbers like 90% of GDP, they start getting extremely worried. So I think, therefore, and this government does value macroeconomic stability. It does value fiscal prudence. It does value what markets think about. I know that for a fact that they do value how markets view this, and therefore there will be, or should be, I don't know whether there will be, but there should be some reasonable plan for medium term. It doesn't have to be dramatic. It doesn't have to be abrupt, but some sense that we're aware that we need to consolidate over the medium term. I hope that will be part of it.
Excellent. Thank you. No, I think the economic survey today actually has a signal that, redistribution is very important. I'm paraphrasing. It's important, but you cannot keep on redistributing till the economic pie actually grows. So that's a sign that the budget might actually focus on growth. So be a growth budget, in other words. So in this context, of the budget, the business response to the pandemic is likely to accelerate trends in economic inequality, employment opportunities, inequality in employment opportunities. So the economic survey makes one valid point today, interesting point, that in the course of education, in inequality, the increasing digitalization has actually served to bring in more equality in primary education. It notes that the number of students in rural India who have access to smartphones has risen from about 36% in 2018 all the way to 6.5% in 2020. So more people, more students, young students have access to these digital platforms for education. So in this context, so not just in the budget, Dr. Subramaniam, how can broader economic policy mitigate this, increase access to economic opportunity, etc.? What are your thoughts on this?
Look, in the medium term, if you look back at the last, 25, 30 years, in order to get sustained growth, you have to get, investment and exports going. I think there's too much of a focus on short-term, consumption demand, because, we know for durable growth, investment has to come back and export growth has to come back. I think that's kind of, so for me, kind of the little bit of a question that I've written recently quite a bit on this with my colleague Soumitra Chatterjee, that this whole Atmanirbharta, I'm not sure how consistent that is with getting our exports going. That's for me is a question mark. As you know, trade policy has become more restrictive. Tariffs have gone up quite a bit. Although the government is trying to offset that by giving incentives in form of production subsidies. This inward turn is to me, it's not clear that we can get our exports growing with that inward turn. And I think here, one thing that's worth interesting point that I think all of you should think about is, look, we said that our export strategy, or part of the export strategy, is to attract all the investment that's leaving China. because China is becoming richer, people are also getting more anxious politically about China. That investment we're trying to attract. And that's why the subsidies are being given. After the global financial crisis, not much of that investment came to India, right? That's why. Now there's a second wave that we're trying to attract it. But the question is that those investors who want to come to India and be part of the global supply chain, if they see that, part of what we want to export, where we want to export is to Asia itself, and then India is not part of these Asian, trade agreements like RCEP, is it going to be advantageous for us? Because remember, the notion that we can attract investment just for the domestic market, that's an illusion. Our domestic market is actually quite small compared to the global market. And that's why I think I have questions about the whole, trade strategy, but we can talk about that. The second big thing, the budget, and I think we should talk about this, is, to get investment back again, we have to get both the financial sector back again and corporate India's balance sheet cleaning up has to happen. So I think addressing the twin balance sheet is going to be absolutely vital, especially as the RBI has signaled that stress is going to increase tremendously. So I think focusing on exports and investment as a medium-term growth strategy is actually what is going to get opportunities, I think, back again. And that's what I think we should be focusing on.
So thank you. That's a great segue into the next question. That's for you, Rajiv. Is this the entire, what are your asks from this budget for the banking sector? There are so many issues. The conservation of capital, for the banking sector, the ability to raise longer term funds, etc. So what are your thoughts of infrastructure finance? What can the budget provide? What can the budget do out in the budget using the fiscal levers and outside of the budget? What are, in coordination with the Reserve Bank and other regulators? A particularly important question, I think, I'd like you to address, is that should some part of our substantial forex reserves, close to $600 billion now, be used for capex? Can some way be found to increase the on the yields on the FX reserves? How much can safely be allocated? And one more important thing. One part is the specific asks from the budget in terms of the banking and other finance sector. The second would be the use of forex reserves. And third, would you advocate the expansion of the credit guarantee scheme? The ECLGS for MSMEs has been one key success, standout success in the stimulus and response measures. So would you advocate more credit guarantee measures across a broader canvas of, say, the farm sector or other stress sectors of the economy?
So let me take the last one, Saugata, first. I think the way that the ECLGS scheme was designed, both in terms of the simplicity, with which it could be executed by the banks, as also the, sort of the impact on the fisc, I thought was very well thought out. So therefore, the impact on the fisc was relatively small, but the overall impact to the system at large was very, very high, and most important, timely. And so therefore, if you looked at it, about 2 lakh crores of money was disbursed under the ECLGS scheme by the various banks to the MSME sector, and then over a period of time, this was extended to some of the stress sectors, including hotels, etc. So I think in a sense, this is a first loss guarantee structure that has got created, has worked well, has got the comfort of bankers as well. And I think as we think about a constrained fisc, where you are really looking to drive infrastructure spend / consumption, structures like this serve multiple purposes. So therefore, to that extent, it brings liquidity and money to the sectors that you want it to, but not necessarily through subsidies, but rather through the banking system. The banking system is anyway surplus at this point in time, and so therefore the adoption of this becomes that much easier as well. So absolutely, I think looking at a extension of the ECLGS scheme, both in terms of amounts as well as sectors as well as time, is something that we would certainly recommend. From the perspective of what exactly the banking system requires, I mean, actually it's not a lot. I mean, one is we certainly want to ensure that there is adequate capitalization for the public sector banks. While they continue to lose market share to private sector banks, both on deposits as well as on credit, I think a healthy banking system, including the public sector bank, is an absolute imperative as we think about growth. And so therefore, capitalization of the public sector banks, I think, is an imperative. And you spoke about infrastructure. And I think if you look at the experience of infrastructure financing in this country over the last 10 to 15 years, I think it's fair to say that the banking system has been fairly scarred as it took on long-term asset liability mismatches. It took on regulatory risk and as well as execution risk, which led to the previous NPA cycle. And so therefore, as you look at bank balance sheets, they have actually moved away from long-term infrastructure financing into more granular retail financing. And I think it will take a lot of effort for this to change. And so therefore, as you look at the national infrastructure pipeline, the total spends expected is about 100 lakh crores. We need 25 lakh crores of capital. I'm not sure where that's going to come from, but we still need 75 lakh crores of financing. And I think it's not going to come from the banking system. I mean, maybe a small part of that is going to come from the banking system, but we need to find structures like InvITs, etc., to be able to attract that foreign money. And there are huge pools of money across the world, to be able to attract that money to come into India, to be able to finance our infrastructure. And the beauty of Indian infrastructure really is that, unlike in China, where you build the road today and the demand comes maybe 6 months or 1 year later, here in India, you build the road today and the demand comes to you tomorrow morning. And so therefore, as you think about project IRRs, equity IRRs, they're very, very attractive. And I see no reason why we should not be able to attract money from overseas. The last question on whether we should be using our FX reserves, I actually would like to hear Dr. Subramaniam on that. But my point there is that, unlike Norway, for example, which is or the oil countries which have generated reserves and created sovereign funds, etc., by the sale of oil, it is in a sense permanent capital. The reserves that we have is hot money, and I mean, one could argue on whether you need the whole $600 billion or not. But fundamentally, the composition of the reserves that we have as compared to money that's gone into some of these sovereign funds is very, very different. And so therefore, to use that money to be able to finance long-term infrastructure, I'm not sure how that will work, but I would certainly like to hear from Dr. Subramaniam on that one.
Dr. Subramaniam.
This using finance to reserves to finance in infrastructure. You will recall, I don't know how many of you recall that Monte Ahluwalia called for this, 7-8 years ago under the UPA government, just for the same kind of idea as well. I think that we should all understand that macroeconomically, using reserves to finance something essentially means monetization of all of this. So, reserves are part of the RBI's assets, and basically you want to run those down in order to finance something. So it's really a form of monetary financing. Whether the central bank, finances it by buying government paper, or whether it does it by running down reserves, it's kind of pretty much, macroeconomically same thing. I mean, there's some differences because, there'll be a bit of a difference in terms of the foreign exchange impact, foreign exchange market impact on this, but it's pretty much the same. So I kind of little bit share. I think Rajiv was being a little bit coy and cautious in saying that, and I will probably say it a bit more explicitly, that I think I'm less enamored of these kind of solutions for. See, but then there are two questions here. One, what do we think needs to be done in terms of public sector banks and so on. And second is the financing question. Do we need what vehicles we need for this? I think Rajiv's point is absolutely right, that in the long run, we need to get kind of non-bank financing of infrastructure, right? I think that's absolutely clear. We're still kind of struggling it, whether it should be a new development financial institution, whether it should be bond markets, whether, you get more private equity, all of those discussions I think are very important. But I think in all this, let's not lose sight of two facts, I think. In the last 5 to 6 years, real credit to industry has been negative. Growth has been negative for the last 5-6 years. And that's why our infrastructure is stuck. Now, why is that the case? Is it just a matter of all these things? Or, in order to get the flow situation better, can we do it without addressing our stock problems, i.e., the NPAs in the bank, especially the public sector banks, and the corporate overhang of debt in the corporate sector, which has gone up? I think you cannot run away from that. And I think we should be careful about saying, we need to get credit growth up. Let's create a new investment bank. Let's create a new DFI. All these are, reasonable initiatives. But we have to overcome, the stock problem of the banking system, of the financial system. And that's why I think, addressing the twin balance sheet problem, maybe creating a bad bank, maybe, reviving the bankruptcy, which has been kind of languishing for the last, 12 to 18 months. So I think that's what I'm going to be looking for in the budget as well, is what kinds of measures are being taken to address this stock overhang problem, without which I don't think we can be as confident that, just taking these other things will address the problem.
Again, great. I mean, I know that you have been the earliest proponent, even the author of the twin balance sheet problem. So now it's probably gone on to triple, quadruple balance sheet problems. But you started this discussion. You're the author of this piece. But that leads me, what you said on financing, on banks, credit to corporate sector coming down. Rajiv, there's this discussion now. It's almost pretty much every forum that there is a certain amount of risk aversion that banks are showing in lending. So, is that true? Would you agree with that? That there's actually a set of risk aversion that you see in banks. How would you? What would you recommend in terms of specific measures to increase the overall flow of funds, not just from banks, banks, NBFCs, mutual funds, etc., to the corporate sector? What would your thoughts be on this?
I think one needs to realize that as a bank, we get deposits from typically retail customers, and we need to lend that to corporate and retail customers to be able to make a spread and therefore get a return on equity and therefore, reward our shareholders, etc. And so therefore, to say that banks have been risk averse, I think is, I've heard this very often, but if you look at this in two parts, one is, over the last 2 to 3 years or more like 5 to 7 years, banks have focused on, like I mentioned, they pivoted away from corporate to retail. Not because there was an aversion to corporate, but there was no demand. When was the last very large project that you heard which required funding? We spoke about the fact that private capex has not gone up now for almost 5 to 7 years, and so therefore in that sort of an environment, if there is no demand from the corporate sector for private capex, it is fair to say that credit demand is also going to be muted. What we've also seen is that over the last, remember that the economy was already relatively weak pre-COVID, and so therefore capacity utilizations were low, and as a result of that, working capital utilizations were sort of relatively low, and that's only carried forward as we went into the pandemic. One hopes that we are now beginning to hear at least some signs of some corporates talking about reasonably large private capex as in the cement industry, for example. We're hoping that there is also a lot of noise and chatter around the PLI scheme, and we are hoping that some of these will translate into private capex as we go forward. But I don't think there's a risk aversion. I mean, if you look at even the last quarter numbers, I mean, some of the private sector banks, including us, we have declared results, and what you'll see there is that the growth of the private sector banks is actually significantly higher than the public sector banks. And we spoke about the fact that net of State Bank of India and maybe PNB and Bank of Baroda, the other banks are grappling with their own issues, including capital consolidation, etc. And therefore, the overall numbers have been relatively weak. What we're also now seeing is, through the pandemic, where retail used to grow at 15% plus, that number is obviously slowed, both in terms of the lack of demand from retail, but also an element of risk aversion, particularly to unsecured loans, from banks as well. So I think it's the banks are here for the clients who have the demand, who are bankable. There is no shortage of money. In fact, they're able to get money at very, very fine rates. I mean, and you've seen some of the levels at which corporate bonds are trading at this point in time. I mean, 3-year, 5-year bonds are trading at 5.25, 4.75. Those kind of levels, which are we have never seen those kind of levels, and so therefore money is available for the people that want it. But most of that, what we're seeing today, is more refinancing than new private capex.
Absolutely. One thing that I think will keep up to some part of the questions that Dr. Subramaniam mentioned, the stock problem of stressed assets. So I wanted both of your views on this bad bank, but let's keep that for the time being. Keep that aside. We are running out of time. Dr. Subramaniam, for you, the final question in this discussion. So you've written extensively on constraints on high sustained growth rate being more in the nature of software rather than hardware. You've written recently on this. This implies probably, I mean, I'll let you elaborate on this. It implies the need to build capacities in our policy and regulatory system to move towards a stable and predictable policy environment. So what are your thoughts on this particular aspect?
Yeah. See, I think if you look back at the last, this government, there have been, impressive achievements. All these schemes that have been done, increase in cooking gas, sanitation, what I call the new welfareism. Broadly, macroeconomic stability has been there, and also a number of important policy actions have been taken. But somehow all of this has not translated into, a real revival of dynamism and growth in the economy. And as Rajiv also said, and this is what we wrote a year ago, that the economy pre-COVID was also already weak, and that's why, the COVID impact was fairly severe on India. So the question is, why is that the case? And I think there is some need to improve. When I say software, you can interpret it in different ways. It's governance, it's kind of the design and implementation of policy, it's being able to, be fair, have a level playing field, following rule of law, tax administration is easy and not onerous and targeting people, and on policy, there should be some consistency. You can't say we believe in the IBC and then you kind of withdraw from that, doubling farmer income, but then you impose export controls and stuff on farmers. So even on the income tax side, I don't know how many of you recall that, while the government and, Mr. Jaitley were very keen to, gradually expand the income tax net so that India becomes a nation of taxpayers, in 2019, the thresholds were increased so much that, 60% of taxpayers completely dropped out of the tax net. So I think this going back and forth, even on the GST, we saw, great achievement in terms of getting states on board, but then some loss of trust on the part of states and all the wrangling over, compensation and all of those things. So I think that's what we mean by the software. So, for example, even in this next budget, and Shogato, you referred to this earlier, a lot of this off-balance sheet expenditures were happening. Can we kind of clean it up and, say, we want to be transparent, we want good data systems, we will, be consistent in policy, we will kind of include, software and also soft power rather than, hard power, consult more with the states, whether it's the vaccine rollout or agriculture or GST. I think that is going to be, for me, a very important signal, which is something that's going to be beyond the budget itself in terms of how the economy is going to evolve based on what, signal and direction and kind of what sensibility in some ways the government brings to broader economic policy making.
Thank you again. I still have a list of 15 topics, but we have run out of time at least for the discussion part.
I have a couple of questions for Dr. Subramaniam, if I may. Two questions, Dr. Subramaniam. When will we start taxing agricultural income? At least a threshold over, I don't know, 10 lakhs, 15 lakhs, 25 lakhs. And second is, if you can share with us your most memorable anecdote as you worked in North Block.
Okay. I see on the first question is relatively kind of easy to answer. The Constitution prevents the center from taxing agricultural incomes. So unless we get a constitutional amendment, the center cannot. But nothing prevents state governments from taxing agricultural income. So one of the bigger issues about India, which I think it's getting lost in the last 4 or 5 years, is that, we tend to always say, the center is right or the center is wrong, and we kind of blame the center for many of these things. States also can have a lot of leeway in some of these things. And, it's just that they don't seem to want to exercise that, if you think the center is not going to tax agricultural income, forget about, the Punjab government or the Haryana government or any other government, state government, taxing agricultural incomes. So I think it's just, unless we do something more broad and sustainable about agriculture, I think the ability for the center to tax agricultural incomes is just is off. I think my most memorable moment, there are many memorable moments, but I think probably for me, the most memorable moment, and this relates to my software point about and software hardware, is in fact, how Mr. Arun Jaitley got opposition states, opposition parties, to bring them together to kind of successfully negotiate the GST. So let me tell you this really interesting incident that happened. So you'll all recall that when the debate happened on the GST in 2016, I think it was August of 2016, so it seems like many years ago, we had this fantastic, rich debate. I think it would be kind of like the debates probably that happened in the 50s and 60s, genuine back and forth understanding. And it was not just Congress, but also the other parties were all it was just to be there, watch that debate, was really to be proud about Indian democracy and Indian parliamentary democracy. It was really fantastic. And then, so we started voting on the GST, and because the deals had been done, it was going to be a unanimous vote because everyone had come on board. And in fact, it was not just one vote, but there were like 7 or 8 kind of sub votes that had to happen. So what happened was, when the first vote was taken and everyone looked up at the ceiling and it said, 400 to 0. So everyone clapped and said, unanimous, GST has gone through. Then the next question was put on the board and the number said 420 0. We were all a bit puzzled what is going on. And then the next question was put, and then the vote was 385 to 0 or something like this. Then it became clear that the BJP parliamentarians didn't know how to use the technology. The MPs didn't know how to use the technology. So for the first only time I've seen Mr. Arun Jaitley being angry in public, he turned around to his backbenchers and said, "Bewakoofon ko vote karna nahi aata."
Thank you.
Great, great. So, I mean, as you would have noticed, I mean, we have focused more on the real side of economic activity. We haven't touched so much on markets, obviously. I mean, with this budget coming in, with the contours of the budget, then the normalization process of monetary policy thereafter. So, I'm going to get in a question which sounds like a middle ground. The question from Mr. Basant Bafna, the Treasury Chief of Exim Bank. So we have been hearing quite now more and more on public goods. I mean, from the Reserve Bank, that financial stability is a public good. From the economic survey, that data is a public good, etc. Mr. Bafna asks, are FX and bond markets public goods? Should these be managed or allowed to move freely? Let's start with you, Dr. Subramaniam, and then I'll toss the question to you, Rajiv, as well.
Well, I think the answer to that is what we actually see, right? I mean, all these markets are a combination of allowing the private sector to work, but we have, regulation to ensure that, the excesses, insider trading, collusion, all of those things, having the appropriate infrastructure, having the appropriate, accounting procedures, whatever, on which all this is based. So I think that's kind of the balance we try and strike. So it's not kind of, so you're absolutely right. It is a public good. For example, if something happens in the financial markets, it affects the entire economy. So in that sense, there are externalities from each of these markets. And that's why I think, we have this already. We have we have SEBI, we have the RBI, we have the various regulatory agencies. I think the question then to ask is not whether we need or not need, but whether the regulation that we have in place, whether that's effective, that needs to be changed in some ways, and so on. So, I mean, let's be honest about this. We know that on the banking system and the financial system, regulation has been, I would say, very, very poor and ineffective. We've had so many problems in the financial system. Start with ILFS and what happened last year with the Divan housing and so on, and we can go back, etc., etc. I don't want to name names, but I think therefore the question is not should we have regulation or not. I mean, we need markets, we need regulation, but the question, at least in India over the last 5 years, is what is the problem with regulation? Why hasn't it been able to prevent some of the problems that have arisen?
Rajiv, the same question to you from your past experience as a fund manager, of treasury heads, etc., and from your current. So do you think, the financial markets would be able to, if the government and the regulators adopt a hands-off approach to these markets, how would you think would the financial sector be able to manage the consequent volatility?
It's never going to happen. I mean, if you see across the world, I mean, it's not just in the Indian context. I think given the fact that these are, in a sense, there is multiple transactions which have an impact on the real economy. Whether you look at equity markets, look at fixed income, look at FX, it has multiple impacts. And one of the things that regulators are looking to manage is not necessarily directionally to move the markets one way or the other, but rather to manage volatility. And therefore, if you look at equity markets, for example, they have circuit breakers, etc., to manage the volatility that comes to these markets from time to time. And I think as we become more and more globalized, so to speak, I mean, now even in the fixed income markets, the amount of money that we have from foreign institutional investors is material. And therefore, as a fund manager sitting in Boston or in Singapore decides to move his exposures into or away from emerging markets and therefore into India, it will bring in an element of volatility into markets. Similarly, we are seeing the same thing in the equity markets. But the beauty of the equity markets has been that the local institutional market, mutual funds, insurance, etc., have grown tremendously over the last 10 to 15 years and have actually provided a counterbalance to the volatility that the foreign institutional investor brings. And so therefore, I think, this is not going to change. You are in financial services, you're in financial markets, expect more, not less regulation. And I think ultimately regulators will regulate and financial markets will innovate and that tussle will always continue.
Yeah, and just to add, even as we speak, we know what's been happening in the last, 3-4 days. I mean, the notion that I think Rajiv put it very well, that it's going to be this constant, the way I would put it is that, it's a tussle between innovation and regulation, but on both sides, there's going to be, the innovation can be kind of good innovation and kind of dicey innovation. The regulation can be good regulation and, kind of ineffective regulation or even over-regulation. So that's, I think, the ongoing battle that, it's as old as human history, and that will continue going forward as well.
So the next question, just to push this topic a little bit further down. So Mr. Shubham Verma from Tata Steel. So, and this is again for both of you. Dr. Subramaniam, why don't you take the first shot at this? What is the fair level of the rupee, of the INR? Does a concept of fair level even exist outside of theory?
I think that that's a fundamentally unanswerable question. I think that I think what is fair to say is that it's probably easier to get a sense of when currencies are, clearly out of line one way or the other. I think that's a judgment call that is kind of, more or less difficult to make. But that's quite a range. You can say, we know that, maybe, I don't know, going back in 2013, just before the taper tantrum, whatever leading up to it, we know that, the currency, Indian currency became too strong, it was going to come down. So I think both economists and in financial markets, we were able to get a better sense of when countries are out of line. So that gives a whole range. So, I would say a range of about, 15-20% both ways, 10-15% both ways. You can, you can't really say whether that's fair or unfair. It's more like you have to think in terms of ranges. And I think spot when this really out of line starts happening. And that's when I think markets kind of really scent blood one way or the other and kind of are quick to act on it. I think that would be, one way I would think about it.
So again, same thing to you, Rajiv. From a portfolio point of view, what would you think your views, your thoughts on corporate thinking on this might be?
So I think over the years, what the markets have latched on to is RBI's real effective exchange rate, isn't it? So therefore there is a range within which the rupee should be bobbing, not necessarily against just the dollar, but against all our trading partners. And that's given you a good idea of, what that range, that Dr. Subramaniam was talking about, what that range should be. And, and as long as the rupee is bobbing between the two sides on the two sides, I think we should be, broadly comfortable.
Again, now switching back to the real economy, Mr. Gautam from Bharti Airtel asks, how can the government push MSMEs to grow scale? That's patently, both for you, but Dr. Subramaniam, why don't you start on this? How can the government push MSMEs to grow scale?
Yeah, if I were to look back on, 35, 40, 50 years of Indian experience on this. The fact that India has not been a major exporter of clothing, textiles, and low-skill products over the years, like China, Vietnam, Bangladesh, all these other countries have been. It's partly, and there are lots of reasons for that, but it's partly because something about Indian economic policy making over many, many decades, as it were, it kind of put a tax on becoming big. For a number of reasons. In the old days, we had small scale reservation, only small people can produce this. We have all our labor laws, which says if you have more than so many employees, the regulators get very active and so on. So we've always, I think, thought of scale or becoming big as not something that we really target and kind of encourage. We've either valued, small scale because they're small. It's kind of like the Gandhian legacy, small is good. Or, we've had these big companies, but that process of from small to becoming big, which is, I think, the heart of what has made all these East Asian countries so dynamic in the way they export and they grow. And that's been, I think, a long-term failure of Indian economic policy making. And, is this can this be changed easily going forward? I think it's not any one or two things that you do. I know I won't name names, but when I was in government, a very, very prominent exporter, very globally competitive, he said to me, and that words have always stuck in my head. He said, Dr. Subramanian, I will never commit to having a biggish plant of, even in my sector, clothing sector, I would rather have, 25 plants, pay the price where each plant has no more than 500,000 employees, rather than having one plant like Foxconn, which is like 50,000 employees, because I just don't trust. I don't have confidence that something happens. The government will back me or not, and I will be very vulnerable if I become very big. So the answer to the question is, it's not easy. It's not something, any one thing that you need to do. I mean, we need to have a broader culture of, regulatory culture, policy environment, private sector culture, of actually aspiring to become big, to attaining scale. I think that we've not been terribly successful at that. You see, why is our manufacturing still only 15% of GDP? It's share of employment much lower, and so that I think is a bit of a problem.
Absolutely. So the issue of stunting that's been bedeviling us for a long time. So Rajiv, from a bank's perspective, the commercial banking group, the small business group, what are your thoughts on this? I mean, what do you think? I mean, particularly from a credit perspective, a credit flow perspective, what do you think would be the way to boost MSMEs?
So I think as I talk to MSMEs in our portfolios, actually I am very impressed by the quality of talent, the quality of the passion of the entrepreneur, etc. So I don't think that the entrepreneurship is a problem. But I think I tend to agree with what Dr. Subramanian said, is that I think over a period of time we have created a culture where 250 crores is considered to be large, which is what an SME is, right? I mean, the equivalent number in China would be 3,000 crores, right? And so therefore, what exactly has driven this? I'm really not sure. And remember that we have 70 million MSMEs in this country. They employ about 120, 130 million people. So the tail is very long. And therefore, to that extent, effectively we've become a nation of shopkeepers, etc., who will, in a sense, never scale to that next level. But I think this is certainly a question which needs deeper introspection on how can we get our people to think much bigger. And if you look at what's happened to textiles and garments, I mean, rather than be exporting textiles and garments, we've actually exported the entire industry out to places like Bangladesh. And therefore, what exactly has driven that? Certainly needs introspection, both from the entrepreneur as well as from the government, in trying to figure out what are those rules and regulations and laws, etc., which is stunting growth.
Again, I mean, hopefully, I mean, the entire process, the change of consolidation, formalization will address some parts of the problem. But let's hope. There are lots of questions on the immediate stimulus and so on, but we have run out of time. So let me try to finish on a longer term perspective. And this is a question from Aniket from Tech Mahindra. What kind of economy can India aspire to be in 10 years' time? What are the steps, on the lines of the $5 trillion economy? What can the economy aspire to in the next 10 years? And what steps are needed for this? So briefly, otherwise I'll be hauled up for extending the time. And so both, anybody, Dr. Subramaniam.
Please, Dr. Subramaniam.
Yeah, I think that, it's not difficult having kind of visions about, where we want to go. I think there are visions come quite, freely, 5 trillion, 10 trillion, bigger than China, smaller than China, better than Bangladesh. I think all these are, I'm not saying that one shouldn't have visions. I think it is about having a vision, but I think more and more we see that, the challenge in India, especially because it's such a large, complicated country, center, states, different institutions, so on. If there's one thing, and this is, I'm speaking, maybe I'm a bit biased, speaking from personal experience. I mean, for me, the kind of statecraft and governance that went into making the GST come about. And this is something Mr. Arun Jaitley used to say, that, in India now, almost every issue that you do, the center and the states both have a stake. So I think really cooperative federalism as, making it a day-to-day reality in the country, center, states coming together, parties coming together. And I think if we could, so in some sense, for me, the cooperative federalism itself would be the vision for India, that, and if we have that, obviously we're not going to get agreement all the time, we're not going to get the same views all the time, but I think if we can, think together as a country, center and states, and have that kind of framework, then I think we can do a lot of things, we can achieve a lot of things, and so on. So for me, more and more that's becoming, and especially with the kinds of things we've seen in the last few years, where what happens if you can't get that, center state cooperation, how things can go bad or go wrong. So this is maybe not the answer you're looking for, but especially because, it's about politics, it's about policy making, it's about handling this large country, diverse country. Cooperative federalism, I would almost make it like a kind of vision for India.
Rajiv, final coda on this. I mean, I have 1 minute time, I'm told. So in line with Axis Bank's own GPS timeline strategies 2022-2025.
I think our focus needs to be on the services sector for multiple reasons. I think we've got a bit of a head start there. Two is your ability to create employment within that sector is actually much better. Going after manufacturing, perhaps that ship has sailed, is where I want to leave it.
So now, I mean, thank you, both of you, so much, Dr. Subramanian, Rajiv, thank you so much for this. Ajit, all yours.
Thank you very much, all of you. On behalf of Axis Bank, that concludes this webinar. I would like to take a moment to convey our gratitude to our external panelist, Dr. Arvind Subramanian, for taking out his valuable time. We look forward to all our customers joining us soon on our next edition of Axis Bank Treasury Market Talks. Once again, thank you all for joining us. Ladies and gentlemen, you may now log out from this webinar. Thank you.